Okay, let's get started. Remind us again, your quiz is on Monday. Your quiz is on Monday. I sent you the review session links yesterday. It'll cover everything that we have in lecture note packet 1, from growth, which was the end of the, we stopped just before growth for the first quiz, from growth all the way through the end of DCF. And if you think about it, there are lots of stuff we did, right? Cash, cross holdings, equity options. They're all fair game. So a lot of small details. None of them is complex, but they can all add up. Okay? Second, I think, I'm not quite sure, that I have all your DCFs back. Okay? If you didn't get it, there's something that I must have messed up on. I skipped over your email by mistake. But if you did not get your DCF back, send it to me again right after class today. I will look at it and send it back to you. Right? So let's get started. We're talking about pricing in the last class. So today we're start of the class test. We're going to look at the contrast between price and value and why the pricing game, as I'm going to call it, can give you a very different answer from the value game. Let me ask you a question. This is an extension of what we did now in terms of, when we talked about commodity companies last session. Is it possible to value a commodity company without taking a point of view on commodity prices? In other words, can you value an oil company without having a point of view on oil prices? What do you think, Fernando? In other words, it's not even that you have to keep the prices straight. If you take, for instance, when I did Royal Dutch, I took the price as a given. You're actually allowing for prices to change at the forward rate. Because remember, you can lock in prices. You can value a commodity company without having a point of view on commodity prices. And it's a good thing when you do that. You know why? Because then when I tell you to buy Royal Dutch, why am I telling you to buy Royal Dutch? Because I think it's a good company, not because I think oil prices are going to go up. Okay? Now let's build on that thing. Let's say you valued Amazon. A few people in this class are valuing Amazon. Let's say you come up with a value of $5.15 per share. So you can change this to whichever company you're doing. Salesforce, what do you come up with as a value? Do you remember? 50 something per share. So you got a value per share. The stock is trading at $6.25 per share, and you can put in your company's stock price in there. Which of the following statements would you more buy into? that the market is much less optimistic about the company's fundamentals than you are, or the market is much more optimistic about the company? This is an easy one. Come on. What do you think? Is the market being more optimistic than you or less optimistic than you? It has to be more. The price is high. When you see a market price, there is an embedded story in that market price. You have your own story. The market story can be more optimistic than yours or more pessimistic. It's not more correct. The reason I say that is that I've had at least 15 or 20 of you come back to me with the evaluation say, my value is too different from the price. How do I make it closer? It's both natural and dangerous. Do you see why it's natural? Because you feel if the value is very different from the price, you must have screwed up. That if there's something you could fix to make the value close to the price, you feel more correct, right? In fact, you know when you're going to feel absolutely correct? Is the value is equal to the price. And that's why it's so dangerous. Because if that's where you end up, then you would ask, why did we go? You've gone through weeks of torture to get here, right? You could have just looked up the Wall Street Journal and said, value today is whatever the price. Ultimately, though, this has to come from practice. It has to come from I use the word faith. You have to start having faith in your own valuations for you to be able to get to that point and say, my value is different from the price, and that's a good thing. Okay? But don't push it. It will come if you keep working on valuations. So let's say you find a company to be undervalued, and we talk about it, and you're deciding, hey, should I act on this? Which of the following do you need to have? Do you have to have faith in your estimate of value, faith that the stock price will move to the value, faith that you can hold on long enough to see that happen, all of the above, or none of the above? You have to have faith in your value to invest in it. Right? If your company is undervalued, to invest in the stock, if you don't have faith in the value, then you're not going to be acting. You have to have faith that the stock price will move towards the value, faith that you can hold on long enough. But if you're undervalued, none of these have to apply. It's only when you have to act that all of these things kick in. You can find something to be undervalued and just leave it there. But to act on your undervaluation, you have to have faith that your valuation is right, faith that the price will correct, and faith that you can hold on long enough to see it happen. The third is sometimes not in your control, right? I mean, if you're investing other people's money, they might come back and say, I want my money back, you're not doing well. But the word faith is going to keep showing up again and again in this class because ultimately to be able to act on your valuations, you need faith. So let's now talk about that last piece of packet one. If you didn't bring it, that's okay. How many of you had trouble printing off the PDF version of that file that I sent? Okay. Because it's some layered thing, don't even ask me what it is. It's just crazy stuff. I can print it off my Mac, but I can't print it off a PC. Again, I can't explain that. Okay? So I did send out that PowerPoint version. Okay? So if you get a chance, print it off. So let me go back to that last page I left you with. Remember I talked about what drives price? Talked about mood and momentum, soccer losses and stock prices the next day. How liquidity matters incrementally. So the pricing process is driven by very different forces than the value process. Okay? So here's where I want to go next. So you have the pricing process deliver a price, the value process deliver a value. If you believe in efficient markets, what are you telling me about the two processes? That they will tend to converge. So if you're a believer in efficient markets, when I ask you what's the gap between value and price, your reaction is there is no gap. They're going to be pretty equal. If you're a value investor, and I'm going to call you a value extremist, an investor who believes in value, you're the kind of person who shows up in Omaha every year to pay homage. Here's what you believe about the process. You believe that the value process is the true way to think about value, that the pricing process is driven by these crazy short-term people, that eventually the truth will win out and the price has to move to the value. So all you have to do is stand there and the price will come to you. So in your world, all you do is value and the price will adjust and you make money and then live happily ever after. If you're a trader, you say, who cares about value? All you need to do is buy at a low price and sell at a high price. So what do I care what the value of the company is? So if you divide the world up, there are people in Omaha who say the market's all crazy, the price is going to adjust the value. You have people in New York trading who say, who cares about the value? It's all about buying at a low. And it's almost like the two groups can't talk to each other. So I'd like you to start thinking already about where you fall in this game. Perhaps after valuing 5 companies, you might decide the efficient market people are not that stupid after all. That maybe value and price are really pretty close, and just, in which case, what should you do with your money? Invest in index funds, ETFs, just walk away from this process. You could buy into the value side of the story and say, you know what, prices usually adjust to value. I'm going to buy stocks that are undervalued and hope the price adjusts. Or you might end up being a trader saying, I don't care about value. I'm going to buy at a low price and sell at a high price. But with each one, I'll tell you what your dilemma is going to be. If you're a trader, here are your dilemmas. You're basically playing the pricing game. You buy at a low price, you sell at a high price. Your first and biggest problem is you have no anchor, right? Basically, it's whatever the market price is. If it goes up, you go up with it. And because you have no anchor, you're going to be reactive. You can't be proactive as a trader. You're going to be reactive. The second, and the other is you're playing this game of trying to forecast what the crowd's going to do. I'll give you a reading suggestion. It's called The Madness of Crowds. Have you ever read this book? It's been around 150 years. It's one of the oldest books in finance. It was actually written about the South Sea bubble and tulip bulbs. Have you heard of these bubbles? The tulip bulb bubble, there's a period in the 1700s in Holland where tulip bulbs became the investment that people made. So the price of a tulip bulb went as high as $200,000, $250,000 in money of that time. So you're saying, why would somebody pay $200,000 for a tulip bulb? Why would you pay $200,000? Because you hope to sell to somebody else at $250,000. So this became the pricing game, which is nobody cared about the fact that the tulip bulb, it's just a tulip bulb. But they kept pushing the price up. The South Sea bubble was actually a bubble set in the UK, or at that time England, in the 1500s and actually 1600s, where somebody started this company that claimed to do something in the South Sea. It's very mysterious, but they claimed untold riches. And remember, in those days, you talked about untold riches coming from the Far East. People kind of bought it because nobody had ever seen the Far East. They were convinced there was big stacks of gold and spices out there to get. So the South Sea Company was supposedly created to tap these riches. And they went public, and their stock was listed in the early stock exchange. And it was essentially, there was nothing there. The company was actually a shell company that was doing nothing. But they fed rumors to the market, and the price kept going up and up and up. And it was another bubble. The madness of crowd looks at how pricing bubbles get formed, how people do things, how crowds actually behave. And it's interesting. This is set up back 150 years, right? You think those unsophisticated investors probably didn't know much. As you read that book, you're going to discover parallels to today's market. You say, that's pretty strange. The more we learn, the more we stay the same. Because here's what, in the South Sea bubble, here's how rumors would get started. They'd hire a guy who was pretty scruffy, and they'd send the guy into a bar, a pub. Because that's where people hung out in England in the 1600s. And this guy would act like he was getting drunk, and after he looked like he was fully drunk, he'd blurt out some secret about the South Sea Seaport Company. You know what? I'm not supposed to tell anybody, but they're bringing a lot more gold home than they're telling you. And then he'd pass out. And of course, everybody else in the pub thought they had inside information. So the next day, they'd all run out and they'd buy the stock and push up the price. You know what today's version of the pub is? It's called CNBC. So you want to push up a stock, what do? You show up on CNBC. I have a secret for you, just between you, me, and the hundreds of thousands of people watching the show. Let me tell you the secret. Tomorrow the company is going to come out with an announcement that's going to make it look much better. And everybody listening thinks only they're watching TV at that time. Nobody else knows. So tomorrow they call their brokers. I have a secret. I have to trade. I have to buy 10,000 shares. And 100,000 other people are doing. They push up the price. And we haven't changed that much. In fact, it's become easier to propagate rumors than it used to be. You know what that also means? Your bubbles are going to be much bigger than they used to be. So if you think that as we get more rational, we have more information, we have CNBC, if you think bubbles are going to go away, you're dreaming. I think, in fact, bubbles are going to become global. They're going to become much bigger because now you can pass information like that through to the entire world without even trying. So if you get a chance, Look for that book. It's, as I said, The Madness of Crowds. Go to Amazon. There's a paperback version of it. It's a great book to read about how crowds behave and how fickle they are. So if you're a trader, you're completely at the mercy of crowds. Let's look at the value investor's dilemma. There are two dilemmas the value investors face. The first is, and a dilemma that each of us faced after we did the valuation, is you value a company, you come up with a number, but that number is a function of all of the assumptions you made, and you feel uncertain about the value. So you have a value for your company, but if I pushed you and said, how certain are you? I would wager most of you say, I have a number, but I'm not that certain. So as a human being, you want to make that uncertainty go away. And so here are some things that people do. One is they go out and try to put a buffer between the value and the price. It's called a margin of safety. Here's how it works. Okay? You've got a value of 50 something, you said, right? What's the market price? It's okay. I want somebody who found an undervalued stock. Do you find an undervalued stock? How about you? What is this, a whole class of overvalued stocks? Somebody must have. What about you, Rachel? You found Delta to be undervalued?
Kind of fluctuate around that price.
Let's make it undervalued. Now that United has banned leggings on airplanes, that alone could make a story a lot more. So let's say that Rachel finds that Delta is undervalued. Let's say the stock is at 40, what's it at now, 50 something? Okay. Let's say that it drops to 35 and your stock is at 50. Okay. Would you buy the stock? See the question I'm asking, how much higher than the price? That's what a margin of safety does. So margin of safety says, my stock doesn't just have to be undervalued, it has to be undervalued by at least 30%, at least 40%. And you can see why people like to have a big margin of safety, because it makes them feel that this is more of a sure thing. So there's actually a book called The Margin of Safety, written by an investor called Seth Klarman. He's one of the most famous value investors out there. It is actually an impossible book to buy. It's out of print. You can go on Amazon, you can buy a copy of the book for, I think, $5,000 something. It's actually become this value investors collector's item. I wish I'd kept a copy. I gave one away years ago. Okay? But the margin of safety is a value investor's favorite tool, basically. It's let's increase the margin of safety. So let me ask you a question. Would you rather have a 20% margin of safety or a 40% margin of safety? Sounds like a silly question. You say, I'd rather have a 40%. Would you rather have a 40 or an 80? I mean, of course, if I let you just fix the margin of safety, you would say, I want at least a 90% margin of safety before I buy something. In statistics, I don't remember your statistics class, whether you remember type 1 errors versus type 2 errors. Anybody want to tell me what a type 1 error is versus a type 2 error? What's a type 1 error? Type 1 error is when you do something you shouldn't do, right? It's not the way that your statistics professor described it. Type 1 error is when you do something you shouldn't do, and a type 2 error is when you don't do something that you should do. You see how margin of safety kind of isn't. When I increase my margin of safety, what am I doing? I'm reducing my exposure to type 1 error. In other words, I'm less likely to buy an overvalued stock because I built a buffer. But I've increased my likelihood of type 2 error. Now I might not be buying stocks that I should be buying. When you see big margins of safety, and the investor who has a big margin of safety, I always say, what is in your portfolio? Because people boast about how big the margin of safety is. Last time I was in Omaha, value investor came up to me and said, you're DCF guys, you're missing it. I use at least a 50% margin of safety. I said, that's nice. So tell me what your portfolio is in. He said, it's all in cash. So what's that telling you? He's got a 50% margin of safety. So if he ever decides to buy something, it'll be a sure thing, but he just never finds anything to buy. You set your margin of safety too large, you're never going to act. So as you look at your stock, you want to build in a buffer, but be careful that you don't let your risk aversion go crazy and say, I want my buffer to be at least 40, 50, or 60%, because very few stocks will ever get that undervalued. Second, you want to go out and collect more information, right? Many of you have tried this. You do evaluations. I feel uncertain. Let me go get more information on the company. And today it's so easy to get that. You go to Google search, you type the name of your company, you get 150 mentions of your company just in the last day. Be careful what you wish for. You get all that information. You put it into your valuation. Do you think you're going to feel more certain after you've added that information? It never works for me. I collect more information. I actually get more uncertain rather than less uncertain. So be careful in going down that path of going out and collecting more information. You can ask what if questions. What if this, what if that, what if this and that? Okay. This morning I had my corporate finance class hand in their cases, and my corporate finance class, and those of you who are in my corporate finance class remember, I create a case, I concoct a case every. Do you remember what your case was? Netflix. So in last year's case, I created this case where Netflix was going to build a studio in Mumbai and produce content, and then I give all the information, ask groups to tell me whether they'd invest in Netflix studio. This year I decided to make it Home Depot furniture. Where Home Depot decides to go into the furniture business, I give them all the information, and they have a singular mission. So you can use whatever tools you want, but at the end of the analysis, I want you to tell me whether I should invest in Home Depot furniture or whether I shouldn't. No strong buy, semi-strong invest, weak invest, just invest or don't invest. So of course all the project reports come in, and every semester I give this project out. My constant plea is keep it short because I've got to read all your reports. And most of the time people listen, but let's face it, it's much easier to ask what if questions now than it used to be. You run an Excel spreadsheet. It's easy to ask what if this, what if that, as opposed to when I did my MBA between 1979 and 1981. So it was like history. And my first year of the MBA program, 1980, summer, I go looking for a job. And this was one of the worst recessions in US history. This was interest rates that hit 15%. There were no jobs to be found. I finally landed a job, a summer job, at a place called Watermark. It's a company that produced radio shows. In fact, it produced one radio show then. Okay? The radio show it produced was this radio show called American Top 40. It's still around. In fact, I think Ryan Seacrest was in. I don't know who does it now, but it's actually this incredibly creative show. And here's how it works. And if you've ever driven across the U.S. on a Sunday, you will hear this across the country. What they do is they start with the 40th song of the week, and they work down number 39, So it's very creative that they go all the way down to 1. And along the way, they stop and talk about the singer and the song and throw a little bit of gossip in there. So this company had one show, American Top 40, that it sold to 525 stations. And every week, this was a syndicated show. The radio stations would send in $1,000. That's what they paid for the syndication. 525 times 1,000 is 525,000. That was the revenue in the show. One show, pretty profitable. So they wanted to start a second show called Soundtrack of the 60s. And here's what they were going to do. Very creative again. Remember, this is 1980. So guess what they were going to do? Go back 20 years to the same week in 1960 and do what? Count down the top 40 of that week. I told you it was incredibly creative. And here's where I came in. I was hired that summer as the intern to crunch the numbers for the company so that they could decide whether to do the show or not. I'd taken one corporate finance class. So I walk into this, I wouldn't say company because that makes it sound like this big building. It was this one small floor with little cubicles all over. It's a tiny business. So I walk in, having taken one corporate finance class, expecting somebody to hand me cash flows. Because every problem I'd seen came with cash flows. And I said, no, I'm ready to do this analysis of Soundtrack of the 60s. Show me the cash flows. And the CFO hands me a ledger sheet. Have you seen a ledger sheet? Ledger sheets were these old sheets where basically you had a sheet of paper that would go this big with lines already drawn in it. That was the innovation. The lines were already drawn. Because if you had to do cash flows, you actually had to draw lines on paper with a ruler, pain in the neck. A ledger sheet, they already did it for you. So you roll these lines, nothing on the sheet. And I look at it and say, what am I supposed to do? So we've hired you to get, your job is to come up with the cash flows for the show. So I sit there looking at the blank sheet. So what do I do now? Now, how do these shows make money? You have to sell them to stations, right? So the first question I had to address was, how many stations do I think I can sell this show to? So I remember hanging out, outside the cubicle of the marketing head for the company. Remember, he also had a cubicle. Nobody had an office. The business was so small. He absolutely hated me on site. He was one of those creative people who didn't like numbers people, and I was a numbers person. So he acted like I wasn't even there. He kept walking past me for 3 days as if I didn't exist. Finally, I said, look, I need to get started here. I need the number of stations you can sell the show to. He said, I don't know, 200, 300, 400, something like that. And he walked into his cubicle. And I knew this was all I was going to get from this guy. So I went back to my mini cubicle and I got started. So my base case for this project was that they would sell the show to 300 stations. Why it said 200, 300, 400? I picked the middle number. And every line in my ledger sheet was built up exactly the same way, built on these little pieces of information. It took me 6 weeks. At the end of the 6 weeks, I had the cash flows for the show. I don't even know where I got the discount rate. I discounted the cash flows. I came up with the net present value. It was negative. Climactic moment. I think this is great. They're going to love hearing this, and this is exactly why they hired me. So I tell the CEO, look, I've got the numbers worked out for the show. I'm ready to present whenever you are. So he said, come by tomorrow. 3 directors will be here. So there are 4 people sitting around a table drinking out of 1 cup of coffee. So I present the numbers. And I lead up to this climactic moment. I'm building up the suspense as I'm going along. And then finally, I hit them with the big finding. Based on my assessment of this show, you have a negative net present value. You shouldn't do the show. They look at each other, and then they look at me and say, what would happen if you tried 400 stations in there? My stomach dropped. Because remember, each number here is hand worked out, right? With a calculator. It wasn't an abacus. It wasn't that long ago. Each number, so if I change 300 to 400, I have to go through every single number on the sheet and redo it. This is why in 1980 nobody asked what if questions, because you knew what was involved. Today with an Excel spreadsheet, I say, what, 300 to 400? Not a problem, I'll change 300 to 400. The whole spreadsheet gets redone for you. That's a plus and a minus. The plus is now you can ask what if questions. The minus is now you can ask lots of what if questions. And people ask what if questions expecting that if they ask these what if questions, they're going to converge on an answer. In my experience, as you ask what if questions, you actually start to get further and further away from convergence. You actually start diverging. Okay? So when you sit there with the valuation and say, what if I can change the growth rate? Go ahead and try it. But I'll tell you at the end of the process, you're not going to feel more comfortable about what you're doing. You're just going to be changing numbers and coming up with these big ranges in the value and actually getting less comfortable with certainty. So that's part of the reason in the last session I talked about facing up to uncertainty. Remember the Royal Dutch? I'm uncertain about the oil price, right? But rather than wring my hands about how uncertain I am or worry about how much uncertainty affects my value or hiding under the table about uncertainty, what did I do in that valuation? I built in a distribution of oil prices and we did those Monte Carlo simulations. We pulled an oil price out. Face up to uncertainty. Don't hide from it. Uncertainty is not a bug. It's a feature. It's part of the world we're in. So when you value companies, there's no point complaining about how uncertain you feel. I have very little sympathy for you. This is exactly the way the world is. You have to kind of deal with it on its own terms. So when you think about uncertainty about value, those are all things that might or might not help you. The other thing you're uncertain about is even if you feel pretty comfortable about the value, the price has to adjust to the value for you to make money. So you're uncertain about hey, whether that will happen. Remember we talked about there's no guarantee that stock price will converge on value. And second, even if you feel it will happen, you're uncertain about when it will happen. It could happen in 3 years, it could happen in 5, it could happen in 7, it could happen in 21. So when you think about uncertainty as an investor, you have uncertainty on both dimensions. And that's part of the reason when you invest in something, even if you believe it's undervalued, you've got to cross your fingers and hope, even if your value is right, that you will actually make money. One final point. So if you invest in something which is undervalued, usually if you're a small investor, all you have to do is sit and hope, right? Sometimes, you might be able to actually influence the process. So if you're a regular investor, my suggestion to you is take the karmic pose, which is nothing I can do. I've done my work. I've valued the company. The price is lower. I've just got to sit back and hope the price moves. But once in a while, you might be able to be your own catalyst, cause the price to move. You guys familiar with Carl Icahn, Bill Ackman? We've talked about activist investors, right? The next time Carl Icahn takes a big position in a company, watch what he does. In fact, if those of you who've tracked him over time have probably seen what After Carl Icahn takes a position in a company, does he stay silent or is he all over the news? He's everywhere. He's in the Wall Street Journal, he's on CNBC, saying what? Kind of broadcasting that this company is incredibly undervalued and you should all listen to him, because what's he hoping that you will do? That you will push the price up. He is trying to act as his own catalyst. And if you're a big enough investor, an investor with enough influence, I mean, that's part of the reason Warren Buffett almost has a slam dunk, right? Every company invests. If he can invest secretly, what happens the day after when the Wall Street Journal announces that Warren Buffett has taken a position in airline stocks? The airline stocks pop a couple of percent because there are other people who follow him in. But that's Warren Buffett. I'm not Warren Buffett, you're not Warren Buffett, so we can't do that. You can try, right? You can get on the Yahoo message board. Does anybody read that board anymore? And say, Valiant is undervalued, Valiant is undervalued. Hope that somebody reads it, but nobody cares about you. So I take a different tack when it comes to looking for catalysts. I'm looking for something that will make the market take a second look at this company, right? Something that will lead me to believe that maybe they will reassess the company. So let's suppose I screen for undervalued companies. I find 10 undervalued companies. I'm saying, which one should I put my money in? Here's something you might want to check out. Check out the ages of their CEOs. I know this is a morbid thought, but people die, including CEOs. And what you're saying is, when a CEO dies, often a new management comes in. I told you it was morbid. Markets might reassess value. That you want something that makes markets take another look at the stock. And if that doesn't happen, you could be waiting a long time. So this price value dance is something that we go through, and I'll use Apple to kind of illustrate how this dance has played out for me. I valued Apple every 3 months since pretty much December 2010. That was my first valuation of Apple. So the purple triangles that you see are my intrinsic valuations of Apple. So if you go to my blog, you can actually download every single DCF valuation. So in April of 2010, when I valued Apple, I found it to be undervalued by about, the green is the actual stock price. So in April of 2010, it was undervalued by about 11.86%. And by about 24.8, 11.86%. Every quarter since, I've kept track of that number. So the first almost a year and a half that I valued Apple, it stayed undervalued, stayed undervalued, stayed undervalued. Here in August of 2012, I don't know which iPhone it was that came out with revenues jump, big growth. The stock briefly became overvalued for the first time. I actually sold about 3 months ahead. I missed that peak. I sold ahead. So there it becomes overvalued. And then it goes through a period where it goes back to being undervalued. In fact, if you go to August of 2013 or the July of 2013, the stock is undervalued by almost 26%. So if you look at the value part of this process, it's pretty smooth. Not much has happened to Apple in terms of value per share, but the price goes up and down. And you're saying, that's a problem with markets? Why is that a problem? That's why we invest, right? Because when you invest, what you're trying to do is take advantage of Apple's ups and downs. So if you read the Apple blog, that was the blog post that was part of the valuation of the week in the second or the third week, I was pretty open that I'd bought Apple a while back, that it had worked out for me, and that the stock had gone up to 132. And I don't know whether you remember, if any of you read the post, but at the end of the post I said, I think it's pretty close to fully priced, and I'm going to sell at 140. And I went further. Did anybody read that post? Do you remember what I said about how I was going to sell? I said I'm going to put a limit order sell at 140. You know why I did that? Because if I told myself I was going to sell and I just waited for the stock to get to 140, what would I start doing? Stock's done so well, it's up at 140. Let me look for a reason to continue to hold. I know I will do this because I've done this before. And this is something I've learned I should do. I need to automate this process, because if I let myself be the decision maker, I can make some really bad decisions. So whenever I put a buy or a sell, I always put a limit on it, because I know the point at which I want to exit. And in fact, because it's a limit sell, you know how limit sells work, right? The price pops 140, it automatically gets sold. So my Apple shares are gone. And this morning I was looking at equity research reports, and they've all magically increased the target price for Apple to 160, 170, 180, because they want to, the party is so much fun, you don't want to leave. Okay? And that's part of the reason why when you do intrinsic valuation, you might have to build in some discipline into the process by automating parts of the process. Okay? So I'm going to close this session with the scene from one of my favorite movies. Recognize which movie it's from? Come on. No? Come on, it's The Wizard of Oz, right? I'll tell you the whole story in like 2 minutes. And as I tell the story, don't jump on me for saying the story is unrealistic, it can't happen, it's implausible, it's improbable. So this story starts with Dorothy being plucked out of Oz by a tornado / hurricane. I've never figured out what it was. It sucks her up. And then it dumps her in Oz right on top of the Wicked Witch from the East West, and she kills the witch. So facing homicide charges, Dorothy says, I want to go home. So the movie starts with Dorothy landing on the witch and killing the witch, and Dorothy turning to this munchkin standing by the side of the road saying, I need to get back to Kansas. Why you'd want to go back to Kansas if you're in Oz? I don't know. I'd have stayed in Oz. But for some reason, she wanted to go back to Kansas. And the munchkin says, I don't know the answer to that, but you got to go see the Wizard of Oz. He has the answer to everything. And of course, Dorothy says, how do I get to the Wizard of Oz? And follow the yellow brick road. So the whole movie is you follow Dorothy down the yellow brick road. She never walks down the road. She skips, she hops, she dances down the road. And along the way, she collects this motley crew. A cowardly lion that wants courage, a scarecrow that wants something, a tin man that wants... So all of them think that the Wizard of Oz has the answer to whatever they're looking for. 2.5 hours later, that's how long the movie lasts, they get to the Wizard of Oz's chamber. They all walk in. And they all tell the wizard what they came for. So Dorothy says, oh, great wizard, I need to get back to Kansas. I have heard that you have the answer to it. And after they've all given their pleas, the wizard says, come back tomorrow. It's like a government office, like the DMV, come back tomorrow. And they say, look, we've been coming 2.5 hours in movie time. This is like 2 years in regular time. We're here and you tell us to come back tomorrow. Why? And at that point, the cover in front of the wizard drops and you see that there's this little guy in the back and there's really no Wizard of Oz. There's this whole... But the key in the movie is that Dorothy already had everything she needed to get back to Oz. Those red shoes that she clicks and she's back in Kansas. So it turns out that everybody in that group had got what they wanted on the course of the journey, that they didn't have to wait to get to the Wizard of Oz. You think, what's this got to do with valuation? In valuation, you sometimes come up with these questions. Say, if I only can ask the right person, I'll know the answer to the question. What tax rate should I be using? We go around asking 100 people. Or how long will growth last for my company? You think that there's somebody out there, an oracle who knows the answer to all of these questions. There isn't. And that's part of what I said early in this process. You learn valuation. You learn everything you need to learn about valuation on the journey. So when you look at your valuation, you are caught up in what the end number was. It's the process by which you got to the end number that teaches you about the company, the growth, the margins, the reinvestment you had to. And that's why I kept insisting that you try to tell a story, because that is where you learn about valuation. It's not in plugging numbers and coming up with an end value. A machine can do it. You have to be able to learn from the process. So as you go through not just this valuation, but other valuations, try to learn from the process. Don't get too focused on what's my end value, what's the price. That's important, but it can't be everything you do in valuation. So let's get started on packet 2, which is the pricing packet. So if you didn't bring it, not a big deal. You can print it off when you get a chance. So let's talk about pricing. Okay. We've already talked about pricing, so I'll skip these 2 pages. So that part you've seen. Let's talk about the essence of pricing. So pages 2 and 3 you saw as part of the intro to pricing. In pricing, here's what you're trying to do. You're not trying to estimate the value of an asset. You're trying to figure out what somebody would pay for an asset based on what similar assets are being priced at. So if you break down pricing, you'd see 3 ingredients. First, you need to find similar assets, comparable assets, something that you say looks just like your company. Second, you can't compare prices across companies, and here's why. The price per share for Berkshire Hathaway is like $250,000 per share. You have penny stocks that trade at pennies per share. The penny shares are no cheaper than the 200. You can't compare prices because prices are in a sense arbitrary. You have a 2-for-1 stock split, you have your price. So that's why we divide prices by something, price by earnings, price by book value. When you use a multiple, you're using a standardized price. So you got comparable firms, you got a standardized price, and then you try to control for differences by telling me a story. What does that mean? You have a high growth company in a sector where everybody else is low growth. You say, I would expect my company to have a higher PE ratio than everybody else because it has higher growth. Comparables, standardized prices, and a story. Bring them together, you got a pricing. So when we talk about pricing, we're talking about a very different process than valuation. And I'm going to start off with a statement that I've made before, but now I'll back it up. Early in this class, I said almost everything that you see out there that's called a valuation is really a pricing. That most investment banking valuations are pricing. So let me back up that statement. About 15 years ago, I collected about 550 equity research reports from around the globe, different investment banks, different analysts. I must confess, I didn't read most of them. There were too many reports to read. But here's why I collected them. I wanted to see how these 550 equity research analysts put a number on the stock. Out of the 550 equity research reports, 45 were discounted cash flow valuations, less than 10%. 450 were pricing, the multiple and comparables, EV to EBITDA in these 15 companies, price earnings ratio in these 12 companies. 450, 45, you're saying that's 495. What about the other 55? The other 55 were quite scary. I wasn't quite sure what they were doing, but it had nothing to do with equity research. But among the ones I could classify, 10 to 1, pricing outnumbered valuation. So equity research is all pricing all the time. I said maybe it's different in acquisition. So I went out and collected about 100 acquisition valuations, and there it was a pretty more even mix. It was about 50% valuation, 50% pricing. But when I took a closer look at the so-called DCFs there, many of them the terminal value came from using a pricing, 6 times EBITDA, 5 times book value. Most of the valuations that you see out there are more pricing than valuation. And when I first did this 15 years ago, I was surprised. And here's why I was surprised. At the end of every one of my classes, including this one, I'm going to give you an exit question. So by the time we get to May 8th, which will be the last day of class, so May 12th, is it May 12th? May 8th, yeah, I get May 8th, the last day of class. You'd have finished your project by that day. You have to, because it's due that day, right? You can't be still working on it. You'll have done a valuation of your company and a pricing of your company. The valuation will be a DCF, and I'm going to ask you to, that's the next phase of what you're going to do, pricing your company. I'm going to ask you, now that you've valued your company, you priced your company, if you had to pick a way of putting a number to an asset today, that's May 8th, would you rather value the asset or price the asset? So basically the exit question I ask is, now that you've seen what pricing involves and what valuation involves, which would you rather use in attaching a number to a company? And in the 31 years I've taught this class, I always get 70, 20, 10 as my breakdown. 70% say that they'd rather value something than pricing. And that reflects my biases, I guess. About 20% say this pricing thing is a much more direct way of doing things. I never liked that DCF stuff, which is so they go the pricing route. And 10% become believers in efficient markets after they've priced and valued one company. This was much more complicated than I thought it was. Maybe the market's not that stupid. But 7 to 2, when I do that interview, people say they'd rather value something than price it. The reason I say that is I've never done a follow-up interview. 5 years later, when you're at your job, and if I track these people 5 years later and ask them the same question, I'll wager the numbers get shifted. So something seems to happen between the time people leave this class to the time that they get on their desk and start working that makes them go from being true believers in intrinsic valuation to pricers. What do you think it is? It's puzzled me. What do you think it is, Rachel? First is, it's not just easier, it's easier to defend using a multiple than it is to defend a DCF, right? DCF, your assumptions are all there. I can pick them apart. Why do you use this equity risk premium? Why this beta? Why this cash flow? Why this growth rate? Instead, you tell me that you priced a stock at 6 times EBITDA because that's what every other company in the sector is trading at. Think of the target you've given me. It's tiny. I don't like 6 times EBITDA. Here's what you tell me. Take it up with the market. In pricing, that's effectively what you're saying. I am just the messenger. I'm like the realtor who shows you an apartment on 5th Avenue and says, you know what, this will cost you $15 million. You say, that's a lot of money. That's too high a price. You know what the realtor is going to say? Hey, that's what people are paying. In pricing, I am just the messenger. I'm just delivering the message. You don't like it? Too bad. It's much easier to defend a pricing than it is to defend a valuation. It's also much easier to sell a pricing than to sell a valuation. We forget how much a valuation is selling. Selling to whom? Selling to your clients, selling to your boss, selling to your colleagues. It's so much easier selling a pricing than a valuation. I didn't realize how much easier or why it works so well until I was watching a Seinfeld episode. You've seen Seinfeld, right? The quintessential New York sitcom. So in this episode, one of Jerry's girlfriends accuses him of being crazy. She says, "Jerry, you're crazy." And he says, "If you think I'm crazy, you should see the guy who lives across the hall from me." Talking, of course, about Kramer. Relative to Kramer, who's crazy? Pricing is the same way. You want to sell me something and show me it's cheap. What do you have to show me? Something that's even more expensive. I mean, the analogy I would give is you have cholesterol of 300, it's not too bad. Relative to people who've died of heart attacks in the last week, you look pretty good. All I have to do is pick the right comparables and I can pretty much sell you anything that I want, any asset, any company. It's much easier to sell a pricing than it is to sell a valuation. So selling is easier, defending is easier, and here's the final. And this is the icing on the cake that basically makes pricing so popular. When you price something, you're far more likely to be with the crowd. In other words, when you make a mistake, you will always have lots of company. Why? Because you're with the crowd. You're buying when everybody else is buying. You're selling when everybody else is selling. When you do intrinsic valuation, I think you're more likely to be right, percentage-wise. But when you're wrong, you're more likely to be wrong alone. You know what I mean by wrong alone? Intrinsic valuation is very contrarian. It'll often lead you to buy things when other people are selling and sell things when other people are buying. That's its strength. But that's also its weakness, because if you're wrong alone, you know what happens to you? You get fired. This is actually a survival instinct. It's easier to survive in this business by making the same mistake that everybody else is making. And with pricing, that's exactly what you're going to be doing. So when I first started teaching this class, I used to try to talk people out of pricing. I'd say, look, you should be doing valuation. I don't do that anymore. Because many of you will end up in jobs where your job is pricing, not valuation. You have to price things. So I'd like to give you the tools to do pricing a little better, rather than talking, because let's face it, if you have to price things, there's no point valuing them. So let's get this process started by looking at why, even if you're a true believer in intrinsic valuation, it makes sense for you to understand pricing. And I came late to this game. I wanted to do DCFs in every company. But I learned very quickly that when I did a DCF and I presented it to somebody and they said, well, that's nice, but what kind of PE ratio will this translate into? If I could not give them an answer, they would not listen to me on my DCF. So even if you're a believer in intrinsic valuation, I think you will find yourself better off if you learn pricing as well. So this is not an either or for me. I will do a valuation of a company and I'll also do a pricing of a company, because knowing both can't hurt you. I might still act on my valuation, but I need to know what the pricing is. And I think if you look at how people get judged in this market, and you've seen Morningstar's ranking of mutual funds, you know how they rank mutual funds? Not based on absolute returns, but based on relative returns. So if you lose 7% as a mutual fund, you're saying that's terrible? Well, if everybody else is losing 15%, you lose only 7%, you look like a hero. So when you look at how we judge people, how we reward and punish them, we reward them on a relative basis. Not surprisingly, that leads us to use pricing. So here's the start of what I'd like to do. Let's break down what goes into a multiple. Right? You've all seen multiples reported for companies, PE ratios, EV to EBITDA, price to book. In the numerator of a multiple is always a measure of market value. And you might see three variations of what you might find in the numerator. The first is the market value of equity. That's called market capitalization. Price per share times number of shares outstanding. So when you go to Yahoo Finance or Bloomberg and you see market capitalization, you're getting a market value of equity. The second is market value of equity plus market value of debt. That's called the market value of the entire firm. And the third is market value of equity plus market value of debt minus cash. That's called enterprise value. All three are measures of market value, but one measures just equity, the second measures the entire firm, the third measures just the operating assets of the firm. Market cap, firm value, enterprise value. In the denominator, here are your choices. You could divide by revenues. Why would you want to do that? Desperation sometimes drives you to using revenues because it might be the only positive number. You could divide by something that drives it. So if you're valuing a company that's pre-revenue, which is revenues haven't come, you might divide the market cap by number of users, number of downloads, number of subscribers. So that's the first choice for dividing, is you divide by something that drives revenues. The second is you can divide by earnings. Those earnings can either be earnings to equity investors, net income, earnings per share, or they can be earnings to all investors, operating income. You can divide by cash flows. Net income plus depreciation is cash flow to equity investors, or EBITDA if you're looking at all investors. And finally, you can divide by book value. Why divide by book? Because that's what the accountant tells you the company is worth. You might as well compare what the market's telling you to what the accountant is telling you. Every multiple has a numerator and a denominator. Numerator is a measure of what the market's paying. The denominator is a measure of what the company is generating as revenues, earnings, book value, whatever. So with that in mind, I'm going to give you a 4-step process for deconstructing multiples. What I mean by this is if you go through these 4 steps, by the end of the 4th step, you should be able to tell me whether I'm using a multiple in the right way. Here are the 4 steps. I'm going to start off by defining the multiple. And I'm going to insult you along the way because you're saying, I know what the PE ratio is. I said, really? Let's try it out. And I'm going to argue with every multiple. We have to go back and make sure that when you talk about PE and I talk about PE, we're talking about the same thing. So I'm going to define. And I'm going to pass the multiple through a couple of very simple tests. Then I'm going to describe the multiple. Sounds fancy, right? But I'm going to show you a histogram. Basically, I'm going to take every company with a PE ratio, put it all on a graph, so you can see with your own eyes what's high, what's low, what's typical, rather than might tell you, this is a high PE, this is a low PE, these are the rules of thumb. Why do you need rules of thumb when you have the entire distribution? Third, I'm going to analyze the multiple. I'm going to argue that every multiple has embedded in it all of the assumptions you're running away from. You know what I mean by running away? You don't like DCF, and I think Rachel mentioned lots of assumptions about cash flows, growth, and risk. Guess what? When you use 22 times earnings, you are making assumptions about cash flows, growth, and risk. The only difference is you're not explicit about those assumptions. They're embedded in your multiple. And only then am I going to apply this multiple. Define, describe, analyze, apply. 4-step process. And if you're careful about following the 4 steps, you're going to be okay pricing something. My problem with pricing is that people are in such a hurry to use multiples. They're not willing to go through the first 3. They just want to apply. So let's start with the first of these tests. When I look at a multiple, there are 2 questions I want to answer. The first is this multiple consistently defined? Let me explain. I said every multiple has a numerator and a denominator, right? Here's the rule. If your numerator is an equity value, your denominator has to be an equity value too. If your numerator is a firm or an enterprise value, your denominator has to be a firm or an enterprise value as well. This is cruel and unusual punishment late in the afternoon to hit you with this question, but I'm going to throw a few multiples at you and you tell me whether they're consistently defined. Let's start with the PE ratio. What's in the numerator? Equity value, firm value, enterprise value when you look at a PE ratio. It's equity value, price per share, market cap. So numerator is an equity value. What am I dividing by? Earnings per share. Equity value, firm value, or enterprise value. Earnings per share is net income. Net income goes to equity investors. So earnings per share is an equity value. Thank God for small blessings. The most widely used multiple in the world is okay. Let's check that off the list. PE ratios work. What about EV to EBITDA multiples? What's in the numerator? Market value of equity plus debt minus cash, right? Market value of the operating assets of the company. What's in the denominator? Earnings before interest, taxes, depreciation, amortization. A rough measure of cash flows from operating assets. EV to EBITDA is okay. What about price to EBITDA? Bloomberg actually used to report this for every company until I drew their attention to it, price to EBITDA. What's in the numerator? Equity value. What's in the denominator? Cash flows to operations. Out of the 550 equity research reports I collected, 8 used price to EBITDA. One of them happened to be an old student of mine. So I decided to give him a call. So I called him and he says, who is this? I said, remember that valuation class you had a few years ago? He said, vaguely. I said, it shows. I said, what the hell are you doing? Dividing market value of equity by EBITDA. It's not consistent. He says, no, I'm being consistent. I said, what are you talking about? He said, I use price to EBITDA for all 15 companies in my sector. I said, that's a very strange definition of consistency. Let me ask you a follow-up question. I said, have you been noticing that companies with a lot of debt in your sector keep looking cheap to you? He says, yes, I've been noticing that. I said, have you ever stopped and thought why that might be happening? Why does having a lot... Let's see let's say you as a company go out and borrow $50 billion in buyback stock. What's going to happen to your market cap right after you do that? The number of shares is going to be reduced. The market cap is going to go down roughly by 50 billion, maybe by only 45 billion, but it's going to drop. So the day after you borrow money and buy back stock, your market cap is going to be lower because your company is now more debt, less equity, right? But what happens to your EBITDA? Nothing. It's before interest and taxes. You can borrow till the cows come home and your EBITDA will still be the EBITDA. The more I borrow, the cheaper I will look on a price to EBITDA basis. In fact, if you use price to sales, which I've seen equity research analysts use all the time, you're guilty of the same sin. You just get away with it more often because the kinds of companies we use price to sales tend to be technology companies which have no debt, or perhaps sectors where everybody has the same amount of debt. It is not consistent. It's better to stay consistent when you look at a multiple. So the next multiple you look at, I want you to pass it through the test. What's in the numerator? What's in the denominator? Is this a consistently defined multiple? Then I'm going to ask a follow-up question. You're going to compare this across 15 companies, right? P ratio, EV to EBITDA. Make sure it's uniformly estimated. It's estimated the same way for all 15. You know how difficult that is as a test to meet? Because what am I asking? Are you estimating the earnings per share exactly the same way at all 15 companies? It depends on accounting standards, depending on your fidelity to those standards. Might or might not be true. Is it consistently defined? Is it uniformly estimated? So here's what I'd like to do. I'd like to take a bunch of multiples and ask you whether these are consistently defined and then follow up. So let's take the PE ratio, right? Most widely used multiple in the world. Everybody knows what the PE ratio is. Even Anna Kournikova seemed to know what the PE ratio was. Remember Anna Kournikova? She masqueraded as a tennis player for like a decade, won nothing, but was in every commercial you could think of. So this is actually a commercial that Charles Schwab made in 2001 with Anna Kournikova. So here's how the commercial plays out. Now Anna Kournikova is playing somebody, must have been an actress, she was actually winning. So in tennis, every 2 games you got to switch sides, right? So they're switching sides. In the middle of a tennis match, I don't know why this would come up, Anna turns to whoever she's playing and says, price earnings ratio is price divided by earnings per share. And then she started saying something about preferred dividends that went completely over my head. I remember turning off the TV and saying, does Anna Kournikova really know what the PE ratio is? I know the numerator is supposed to be the current price, usually, unless you got one of those technical analysts gone crazy. And ones I'm talking about who like moving averages for everything. So usually the numerator is what's the price per share. But it's in the denominator that you get the real action. I could divide price per share by earnings per share in the most recent fiscal year. It's called current PE. I can divide price per share by earnings per share in the last 4 quarters, which is called trailing PE. I can divide price per share by expected earnings per share in the next 4 quarters, which is called forward PE. Or I can divide price per share by earnings per share in the year 2026, which is really, really forward PE. Why would I do that? Again, desperation drives me to do strange things. I'm the biotech analyst. 90% of the companies don't make money. What do? I project the earnings out 10 years and say, this stock looks cheap. It's trading at 10 times 2026 earnings. He said, what? You can divide by earnings per share before extraordinary items, after extraordinary items, primary, diluted, partially diluted. In fact, you take any widely followed company, you could probably write 30 to 35 different numbers that are all PE ratios for this company. See, you did this for Cisco. I did this last week for Cisco. I came up with numbers ranging from 14 to 40, depending on which earnings per share I used. So when I used forward earnings per share with an expected earnings in 2018, I got 14. When I used trailing earnings per share after extraordinary items, I got 40. You think, so what? Remember we talked about agenda and biases in the first class? Let's say I'm a person who wants to convince you that Cisco is cheap. So when you ask me what the PE ratio for Cisco is, What's the answer you're going to hear from me? I'm going to say 14. I'm not going to mention the 40. Why would I do that? Because I want to convince you that the stock is cheap. On the other hand, if I wanted to show you Cisco was cheap and say, what's the PE ratio today? I'm going to say 40. Next time you watch CNBC, here's what I want you to do. See these two analysts arguing about a stock. One is bullish, one is bearish. They'll talk about the same stock, widely followed, and they will use two wildly different PE ratios. So how can that be? Same stock, how can you have different PE ratios? There's the answer. It depends on how you compute your price-earnings ratio, and which one you use will depend on what kind of agenda you have. So PE ratios are straightforward until you start digging and you recognize how many vary. That's why whenever I have a discussion with somebody and the person says, this stock is cheap, it's trading at 9 times earnings, PE is 9, I stop them and say, before we go on, could you please tell me what your definition of PE ratio is? And they look at me like I have two heads. You don't know what the PE ratio is? Even Anna Kournikova knows what the PE ratio is. I say, Anna's much smarter than I am. Could you just give me your definition? Because I don't know whether 9 is cheap or expensive until I know whether you use last year's earnings, next year's earnings, or 2026 earnings. I have no idea. So at the risk of sounding stupid, don't let people bulldoze you with multiples. EV to EBITDA is 5. Stop them right there and say, tell me how you came up with the EBITDA. Is it last year's, next year's? It makes a big difference in how you use this multiple. In fact, if I'd been making that commercial, here's what I'd have made that actress do. So when Anna said, no, price earnings is price divided by earnings per share, I'd have made the actress turn to Anna and say, forward earnings or trailing earnings? And then we'd have found out whether Anna Kournikova really knows what the PE ratio is. Okay? So PE ratio is simple until you start digging. Let's stay on price earnings ratios. Let's say that you're looking at the technology sector. Some of you are looking at technology companies, and this is an issue you're going to face in the real world. So guess what you're trying to do? You're looking to see which stock is cheap on a PE ratio basis, right? You have 50 stocks in your portfolio, or in the sector. They're all technology companies. Some have lots of options outstanding, some have no options outstanding. Some have in-the-money options, some have out-of-the-money options. So I'm trying to compute price earnings ratios for each of the 50 companies, so you're making the comparison. Which of these measures of the PE ratio would you use in your comparison? Remember, you want to make sure you're not putting in biases into your comparison. So I'll list each one and you tell me whether you'd use that one, and if you wouldn't use it, what kind of biases you'd be worried about. So you have 50 stocks. I compute the price by primary earnings per share, where I actually divide by the actual shares and I ignore the options. So that's the first approach. If I do that, I divide the price per share by actual earnings per share, I ignore the options. What types of companies are going to look cheap to me? What happens when a company grants lots and lots of options? Its market cap has to go down because I'm giving away more of my equity in options, right? So if I have lots of options outstanding, my price is going to come down, and if I don't adjust for the options in my earnings per share, stocks like Cisco are going to look really cheap to me. So dividing by the primary earnings per share doesn't work. You're saying, well, let's do the fix then. Let's divide by fully diluted earnings per share. What do I do there? I adjust the number of shares for the options outstanding. That takes care of part of the problem, right? But now let's look at two companies. Both have 10 million shares and 10 million options. So basically using 20 million as a diluted share. But one company has 10 million options that are in the money, and one company has 10 million options that are way out of the money. If I divide by fully diluted earnings per share, you know what I'm going to find? The company which has 10 million options which are deep in the money are going to look cheap to me because the price is going to be lower. Those in the money options are worth a lot. My price has to be lower for that. I'm going to be buying that company thinking it's cheap when in fact I should not be buying that company. So I can't use primary, I can't use diluted. I can't even use partially diluted, which is only in the money options. You know how, if I really wanted to be consistent, nobody does this, so trust me on this one. If I really wanted to be consistent about comparing PE ratios across technology companies, here's what I will have to do. I'll have to take the market cap of every company, which is actual shares outstanding times share price. And to that market cap, I have to add the value of the equity options that have been granted by the companies. Now, how the hell would I do that? Remember when we did DCF, we had to value the employee options? I would have to use the same techniques to value the options, bring them into my numerator, make them part of my equity value. Because only then can I be internally consistent. So when you see an analyst looking at technology stocks and not adjusting for options, you might want to bring in the number of options outstanding. S&P Capital IQ actually lets you see how many options are outstanding in your stock. When you download information about your sector, see if you can download that information as well, because it's going to be useful in your comparisons. So now let's talk about enterprise value to EBITDA. When I first became interested in equity research, this is like 30 years ago, I'd go into an equity research department and you'd probably see 1 in 20, 1 in 30 analysts use EV to EBITDA. Today you walk into any equity research department anywhere on Wall Street and you check around. About a third to maybe 40% of all equity research reports are based on EV to EBITDA multiples. So I'll give you the definition, and then I'm going to ask a question that I ask almost every analyst I run into who uses EV to EBITDA this question. Very few of them have the right answer. So in the numerator, here's what you have for EV to EBITDA. Your market value of equity plus market value of debt, though people cheat and use book value of debt for that, minus cash. So in the numerator, you have equity plus debt minus cash. That's enterprise value. And in the denominator, you have earnings before interest, taxes, depreciation, and amortization. So here's my question. And whoever answers this question will get a copy of my newest book signed with the person who knows everything about valuation. Give him any valuation job that comes along. I promise you, I'll write that in the book. So this question is loaded. So here's my question. Why do we net cash out of the numerator? You see what I mean by netting cash? Why am I taking cash out of the numerator?
Because it would be double counting.
Tell me how it's double counting.
It's priced into the value of the
But it's part of the company, right? In the case of Apple, when I buy Apple, don't I get the cash with my shares? It's not cheating, right? $250.
But if you compute the market cap, then you have the share price that
Times-
prices the cash.
In other words, I'm pricing the entire balance. So if you think about the balance sheet, you have cash and operating assets on the asset side. You got equity and debt on the other side. So why would it be double? I mean, to me, it seems fairer to say, if you ask me what the value of Apple as a company is, to me, it's market value of equity plus debt. Why net out cash that's on the other side of the balance sheet? Yeah.
Why are you trying to find a multiple on a company, not on the cash a company holds?
You're closer, but I'll give you a clue. This is not fair because a book with a clue is not, but that's okay. It's got everything to do with that consistency question I gave you. Yeah.
The EBITDA is just the earnings from the core assets. Not
You got it.
cash. So stay consistent.
EBITDA is interest income. When you have cash, you have income from cash, right? There's interest income, but that income shows up below the EBITDA line item. Because it shows up below the EBITDA line item, I shouldn't be including it in my numerator because the income from cash is not part of EBITDA. So you got a copy of the book. I'm going to add a follow-up question, second copy of the book. I have lots of copies, I just want to give them away. Here's my second question. So we take cash out. Why? Because the income from cash is not part of EBITDA. Is there anything else I should be taking out of the numerator, you think? Are there any other assets that you remember from? And think back to your DCF valuations. Are there any other assets that companies own whose income is not part of EBITDA that I should be netting out of the numerator? Yeah. Cross holdings in other companies, right? If I'm valuing Tata Motors, do you see what the problem I'm going to have in my market cap? I'm going to have the values of all the holdings that Tata has. I'm going to treat it as part of the numerator, but income from cross holdings doesn't show up as part of EBITDA, so I'll have to subtract out the market value of all of those cross holdings. Remember I told you that if you thought you were running away from all your problems by using pricing, that they would chase you down? So you didn't like to use DCF for Tata Motors because you had to deal with these cross holdings. Guess what? They're not going away. If you use EV to EBITDA for Tata Motors, you have to net out from the numerator not just cash, but also those cross holdings. If you're doing an EV to EBITDA for Yahoo, from your numerator, you'd have to net out the value of their Alibaba holding and their Yahoo Japan holding, because the income from those holdings are not part of EBITDA. So you have a copy of the book too, so I'm done. 2 copies, that's enough for today. Right? But when you look at, you can see how people use multiples and actually get stuck. What if I have a majority holding in another company? You know what I mean by majority holding? I own 60% of another company. What do I need to do to clean up? Add back the 40% to what? Numerator. 40% of what? Book value? Market value? Market value. You know what analysts add back, they recognize that there's a problem, right? But instead of adding back 40% of the market value, guess what they add back instead? What does the accountant tell you that 40% is worth? What's that called? Minority interest. Remember, the accountant comes in, they add the minority interest back and say, I'm done, when in fact you're not done. You've added 40% of the book value. You should be adding 40% of the market value, because if you have a majority holding, you have a different problem. You've consolidated, but only the accountants consolidate and add 100% of the cash, 100% of the EBITDA. Markets don't consolidate. They just treat you as owning 60. Markets are sensible. They don't do 100% and then subtract out 40. They just say you own 60%. We're going to price it in. You got to bring in the other 40%. I'll also give you a preview on every second quiz I've given in this class. The cross-holding question alone will floor people. Right? There's minority holdings, minority interest. You say, what's the difference? If you're telling me what's the difference, you need to review that, because minority holding is a piece of another company that you own. Minority interest is a piece of another company that you don't own, right? Two very different, but using terms which are very close. You're saying, what's the difference? So you have to start thinking about that divergence, because it can affect not just your DCF, but also your multiples. And let's do one final multiple. After the 2008 crisis, people started asking the question, maybe, especially people in real estate, saying, maybe we get into this tunnel vision in real estate. We have no way of knowing whether things are overpriced because we have nothing to compare it to. So as housing prices go up, you just have to pay what other people are paying. So how do I know I'm paying too much for real estate? Is there a multiple I can use that I can compare to the PE ratio for stocks or the T-bond rate or something there? And this is a multiple that got developed somewhere in, I think it was somewhere in California. They came up with this multiple as a way of measuring whether housing was cheap or expensive. So here's what they did. They took the price of housing, which you can get in any area, and they divided it by the rental income you could get. So basically they took a house price. Take a median house. Let's say it's 500,000 or 100 million. They took the house price of $1 million and divided by the rental income you could make per year on that house. So let's say you can rent the house out for $5,000 a month or $60,000 a year. You divide the million by 60,000, you get about a 16.67 ratio. They said that ratio becomes something you can compare to something. So basically, as an investor, would you rather invest in stocks or rather invest in housing? You want to invest where you get the biggest bang for your buck, where you have to pay the least multiple for earnings. So my question is, if I'm computing my housing pricing by dividing the house price by the rental income, what is the analogous multiple I'd be using in the stock market to make this comparison a fair one? In other words, do you see the question I'm asking? Is housing price closer to equity value or is it enterprise value? Is rental income like an equity income or is it an income on the entire property? And if you can break through that, you can then tell me what the rate. So is the housing price closer to enterprise value or is it closer to market cap? This is the price of the entire house, right? So basically it's closer to an enterprise value. And rental income is the income before you make your, remember you borrowed money to buy the house. I'm not looking at the net income, you're looking at the rental income you collect. It's closer to like an operating income on a company. So if I wanted to do an equivalent multiple in the equity market, I'd take enterprise value divided by EBIT. Right now that number is about 9.83 for the equity market. And if I'm getting a better multiple in the stock market than the housing market, I'm going to say, look, I'm going to put my money in stocks rather than houses. I mean, it's a very rough comparison. So when you think about multiples, think about consistency, not just in the stock market, but anywhere you go. In fact, if I wanted to make this an equity multiple in housing, how would you modify this multiple? First, in the numerator, instead of looking at the housing price, what would I use? How much do you typically borrow for a house? No. Usually about 80%. It used to be 90, but they reduced. So instead of using $1 million in the numerator, I'm going to put up only your equity portion, which is the 20%, which is going to be 20% of $1 million is 200,000. In the denominator, now remember, consistency still rules, right? Instead of dividing by rental income, what should I be dividing by? What do you get as an equity investor in a house? If you rent the house out, you collect the rental income, but what do you have to pay out now? You got to pay your mortgage payments. So if I wanted to make this an equity multiple, in my numerator I'll put the equity portion of the house that I invested, and in the denominator I'm going to look at the income left over from my rental income after I make my interest expenses. There's your PE ratio, if you want to bring a PE ratio into housing. So I know it's an offbeat example, but it's a great way to start thinking about equity versus the entire business, asset versus your investment in the asset. So I'm going to get the next step of the process started, because next class we'll go into the numbers. You've read Moneyball? Michael Lewis's book on the Oakland A's? I'd strongly recommend it. Or if you're too lazy to read, there's a movie that's been made. Great movie. What's the movie? And Michael Lewis's point in the book is, and for those of you who don't know about Moneyball, here's what the story is about. It's about a guy called Billy Beane. He's the general manager for the Oakland A's. Baseball is a sport with a long tradition, 150 years. And for a lot of time it was driven by rules of thumb. These scouts who are like 75 years old would come and say, that guy's going to be a great pitcher. And you ask him, how do you know? Well, I've seen a lot of pitchers and the arm is crooked and they point to the right. It's a great pitcher. And Billy Beane said, why are we listening to these guys? They have no idea what they're talking about. So instead he said, let's look at the numbers. So if you read Moneyball, it's all about how, and it's actually coming to basketball now, sabermetrics and basically looking at the numbers. Next session, what we're going to do is we're going to play Moneyball with multiples. Rather than ask, what's a high PE, what's a low PE? Let's look at the numbers. Let's see what the numbers tell us. Because at the end of that process, you should be able to develop your own rules of thumb. See you on Monday. Wednesday. Monday? Wednesday. Quiz on Monday. So, if you're going to miss the quiz, make sure you let me know before 2 o'clock on Monday, right? So before 2 o'clock.
You said like companies with a lot of options, the shares might be cheap.
Yeah, because if you have a lot of options, the price will be lower.
But the earning per share will be lower.
No?
Like you have
Because
more
you've already
shares.
granted the options. The options are there. Earnings per share is primary earnings per share. You're not dividing, so you're not actually counting the number of shares that you will have to pay. So that's because it's actual shares. So if you have if you use actual shares outstanding, companies with a lot of options will look cheap, because your numerator reflects the fact they have options outstanding, but your denominator does not.
In my DCF, I took out options when including the equity value. I'm wondering, what's the story with options when accounting for equity value?
You have to take it out. You do CF value. If you start, because the equity value, portion of the equity value is going to the option holders, right? You grant options. Who pays for them? You did as an equity investor. So you've given away a slice of equity to those option holders. You have to take that out because that doesn't belong to you anymore.
So I can't ignore them.
You can't ignore it.
What he said is, if it is minority interest, that means I own. For example, in the EBITDA multiple.
Minority interest is when you have a majority holding that you've consolidated. Minority interest reflects a portion of the company that doesn't belong to you.
Oh, which one is the one that doesn't belong to me, the holding?
Minority interest.
Interest. Because I own 60% of this company, so I consolidate 100% of the earnings. I should carve out the 50% I don't own. Right?
That's what is shown as minority interest. And you have to add it to your numerator when you do EV to EBITDA. Because in your numerator, you have market value of equity that reflects only the 60% that belongs to you, and everything else in that equation reflects full consolidation. 100% of the debt, 100% of the EBITDA. So to be consistent, you've got to add the 40%
So this is
back.
opposite to what we just
Exactly. In
learned.
DCF valuation, you move from the other direction. In pricing, you start with the bottom and you move up. DCF, you start with the value of the
I just
average.
did all the practice in that part. And that's
Because in DCF valuation, you move down the process, you subtract out minority interest and add.
Your EBITDA is fixed, so you have to make the...
Here you're starting with the so basically at the end of a DCF, you come up with the value of equity per share, right? In the market, what you observe is the price per share. Now you're working back up that same equation, right? So you're going to start at the market cap and work up through the equation. So whatever you minus, you will now plus, and whatever you plus, you will minus.
One last thing.
Yeah.
Like when I enter at a fund, they always look at like this forward PE ratio instead of the current PE ratio. I was actually blamed for once for mixing that. I don't know why they are so obsessed with forward and they look for like
Well, if they feel that their analysts are very good at forecasting next quarter, let's suppose that that's what you think your strength of your analysts is. They're very good at forecasting next year's earnings. Then you want to use forward earnings per share because that's what you're basing your pricing on. You're saying our analysts are very good at forecasting earnings, and if our analysts are right and the earnings actually goes up, then the price will have to go up.
To
So
determine the P ratio right now is cheaper.
exactly, right. Yeah.
Thank you very much.
Oh no, you're welcome to.
Is there an execs like for the quiz too? Like
The end of packet one.
the end of okay. Because the end of packet one also covers a little bit of pricing.
It's very. There's nothing there that you can even ask questions on.